Morning, ladies and gentlemen. This is Greg McCloskey from FXD News, the Monday, March 29th, 2010 New York Morning Forex Report. I remind everybody that trading Forex is risky, should only be done with risk capital, not change in lifestyle. Traders could lose all their risk capital trading Forex. FXD does not guarantee any recommendations made within its commentary. Traders should make market assessments, check trading positions based on their own personal market analysis, risk tolerance, and financial conditions. In addition, care should be made to only use leverage which is congruent with your personal risk tolerance. Although care was taken in creating this report, FXD does not guarantee the accuracy of the information. We are seeing the euro move up more higher here today on the back of the agreement from EU officials and the IMF in regard to aid for Greece should they need it down the road. This gave the market a little bit more of a positive opening here, that you can say that. And also Greece is going to look to test the 7-year bond market with a debt instrument between now and May. They're going to have to issue what is estimated to be, I think, 23 billion of US dollars worth of debt in the next coming weeks, and that's a huge amount for them. So this 7-year bond issue is they're putting their toe in the water to see if they find the demand. Now, to give you a clue, the last coupon on the 7-year note that they issued was 4.3%. The current rate on the 7-year is yielding 6.01%. So the borrowing costs are going to increase for Greece, and with a debt situation that's not good for a debt situation, so over time they may find that this interest expense is too dear for them, and that's what they're hoping, is that they get lower yields on these issues as a result of the aid that was promised to them from the IMF, from the EU, in a case of dire circumstances. So we will see, but the euro is up stronger. You can see here today how the market did move up. It gapped higher. We are looking at this 50% retracement level of this move down as a resistance level, and that's indeed where the market stopped on Friday. We used to use the 100-hour moving average when the market gapped open. It's time to think to higher levels, think for a higher move to the upside. So let's move our Fibonacci back to this area right here. The last move to the downside, and we'll see where we stand in regard to that Fibonacci. But as you can see here, the market gapped higher, and then it came down and filled that gap. I'm going to zoom in here to show you what I mean. When the market gaps higher, leaves this big, huge open space here. The market came down and filled that old gap. Remember, the 15, 18 level was a key support level from that old Fibonacci level. So we did find support against these old highs, and the market used that as a support and gained some confidence back to the upside. We shot through the top side upside here, and it approached the 200-hour moving average. The 200-hour moving average came in at 135.13. The high at this bar right here came in at 135.06. So there was some resistance and some profit-taking selling against that 200-hour moving average, which is something that we normally look for. And why? Because there's low risk in that trade. If you have if your risk is simply if the market goes above the 200-hour moving average, you simply risk a small amount with the potential for a larger gain to the downside, and that's exactly what happened. Current market is trading at 134.73. That is just below this opening level. The market opened, well, it actually opened at 134.73, so it's right at the level where the market opened, and we'll see which way the market wants to go from here. Taking a look at the 5-minute chart, see if there's any clues from that. You can see the gap opening took it well above the 100-bar moving average on the 5-minute chart. When the market came down, tested the 100-bar moving average. Note the slope is still going higher here, but the market could not penetrate the 200 confirming moving average on the downside. When we started to move back above the 100-bar moving average here, the market started to gain some momentum to the upside here, and that pushed the market to the highs for the day. Let's go on to so from a 5-minute perspective, we do have support at the 134.61. That's a 100-bar moving average in the 5-minute chart. We'll be using that as support. As you can see, the market has been pretty much above the 100-bar moving average for most of the last couple days. Going all the way back to this point right here. In fact, it's been above the 200-bar moving average ever since this point right here. It's moved above the 200, could not get below that confirming 200 moving average, which suggests that the market is in this trending formation to the upside still. And as long as it can remain above these two moving averages, 34.64, 61, 34.47, then the market bias remains to the upside. So look for buyers against a dip in the euro versus US dollar. Taking a look at the daily chart, we are back within this meet here. We had the three lows here, 37. We had a low of 44. We had a low of 50, or 37, 44, and 51. Getting them all mixed up. But the one thing that we are bumping against is this topside resistance from this channel. If you take this high and these lows, and then put a parallel line using the high up here, you get a resistance level against that one. Looks like 135.17, so we get above 135.17. We should see further move to the upside for the euro versus the US dollar. To go into the sterling versus the US dollar, this currency pair will also open higher, and it immediately came down, filled the gap here. But it was below the 100-hour moving average. But at this point right here at 149.33, the market started to move to the upside. We have the 200-hour moving average, which comes up ahead at 150.49. We also went up to the 38.2% retracement of this last move to the downside. So that was a good level for the market to sell against in light of the fact that the euro was reaching its high and peak against resistance. The sterling was also selling against the 38.2% retracement on the 5-minute chart. Very similar pattern to the euro. The market stayed above the 200-bar moving average here after dipping below the 100. Could not gain any momentum to the downside and use it as a springboard. The 100-bar moving average comes in at 149.57 currently at the moment, and that will be the level that we'll be watching. We'll be also watching this 200-bar moving average and the 38.2% retracement of the last move to the upside here. That comes in at 140.934 as our support level on the downside. On the top side, we're going to have to move, as long as the markets stay above this level right here. I would expect that we got to move above these old highs here in order to propel the market to further upside gains. We are also bumping against on the daily chart the old resistance here, this old trend line here. It's always good to put in the old, keep in the old trend line, and you can see here that level. The market went right up to that level at 150.32, so that will be another key upside resistance for this sterling versus the U.S. dollar. Taking a look at the Swissy versus the U.S. dollar, we did correct. We corrected and then moved sharply higher, and corrected, moved sharply lower again off the dollar Swiss. You can see that movement here. This is not conducive to decent trading. The market's moving 100% through levels here. When the market starts to move up in this fashion, and I always like to put a Fibonacci retracement of the day's range. You can see how the market initially came down to the 50% retracement, bounced off that. Once it went through that, it was all over. It went down through the 61.8, and now we're jetting back up of the 61.8. I would stay away from this currency pair. It's being flushed around by interest in the Euro Swiss is also moving around quite a bit. What I can say, I guess, is that we are just at the 200-hour moving average. So if you were going to do a trade, I would do it against this line right here, against the 200-hour moving average. Market moves above that level. Look for a confirmation above the 106.28 level, and then possibly a move to the 100-hour moving average at 106.64. That would be that's how I would trade the dollar Swiss. But given the volatility in the market, be aware. There's a lot of volatility in the market, so risk is increased. The dollar versus yen continues to consolidate at the highs. We moved up sharply last week above the 200-day moving average, consolidating on Friday, consolidating again here today. We do have lower lows. We do have higher highs, so put your trend lines in here at the highs. And of course, I can't get it right. Then we'll not get it right, but you know what I'm talking about. And put your trend line against the lows, and look for the support and resistance in the off of those charts. You also may want to take a look at our two moving averages as well. Although the market's moving above and below them, we do seem to we hold it here. We move above here and move above the 200, given the confirmation. We hold it here, hold it, break through here, then hold it here. So lots of action above and below these moving averages, but they are holding them as support and resistance level. The dollar Canada is moving through. It's a 100-hour moving average here on a move to the downside here. The commodity currencies are getting a bit up again. We have Australia moving up as well sharply, and the dollar Canada is also moving lower. The 102.20 level is a 100-hour moving average. We could stay below that. That would be beneficial for the currency pair. You can see last week we held the 100, and then we came down and held the 200, held the 100. Now we're breaking through the 100. So the bias remains is to the downside for this currency pair. 102.20 risky for that currency pair. I mentioned that the Australian dollar was rallying, and indeed it has. Stevens of the Reserve Bank of Australia was on the television this weekend saying that higher rates are needed in order to keep inflation down. That prompted the Aussie versus US dollar to rally strongly. We're above the 100-hour moving average. That 100-hour moving average comes at 190, 110. The 200-hour moving average, however, has held the top side at 91.49. We're going to need to get through that level on the 49 level in order to push the market even higher. So that's my morning report. We'll talk to you later. Bye-bye. Greg Michaelowski from FXDD.